What's up, y'all? This is Benjamin Day with Lionshare Bookkeeping and Landlord CFO. Today, we're going to be talking about the difference between a CFO and an accountant. So what we want to get into today is pretty boring. I'm not going to lie. Like, this is not what somebody's really looking for, but it's still a conversation that we have most often with folks that are really trying to grow their financial team. They're not quite sure what they need. And so what we like to do with all of this content is we just want to make sure that any accounting or finance question gets answered for our investors. We want to make sure that as you go on this entrepreneurial journey, that you're getting the right player, the right role in your business at the right time. And so this can really change for a lot of different reasons. The last thing that you want to do is hire somebody for your business that you were hoping was going to do something and they end up doing something totally different. Hopefully that's a trend in the right direction, but sometimes people can surprise you and not do the job that you wanted because you just didn't know any better. And so we want to begin to avoid that, if at all possible, by demystifying this accounting and CFO shenanigans. So let's get into it. Number one, if you're looking at hiring a CFO versus an accountant, or you're looking for both, the easiest way to think about this is, do you want somebody that's going to help you deal with your future or with your past? And so let me kind of break this down for you. At the end of the day, rule number one with any amount of financial analysis and accounting and CFO services, bookkeeping is the foundation. We absolutely have to have the data in place before we can make any number of decisions. And so bookkeeping has to be in there from day one. Somebody else's bookkeeping and budgets, your bookkeeping and budgets from how you're currently performing, all of that data is available. We need to have it together so we can make some decisions. What that means, though, from like an accountant versus CFO perspective, is that accountants are going to be looking at the last year's worth of transactions and saying, hey, here are your opportunities for, like the tax savings and tax planning, and really dealing with the numbers of the last 365 days in order to piece together the best plan for you, right? Meanwhile, a CFO is going to look at that same data set and say, okay, so if all of these numbers are true, and this is what actually happened, and this is the action we're taking, then this is the future of the company. And you can do all kinds of fun forecasts and cash flows, and here's how we're going to grow. Here's how we can change. Like the future of the company is firmly inside of the CFO's purview. And so that actually kind of makes it interesting where, like a CPA is really more kind of in the details and grounded, and like, this is what you can do. A CFO has an opportunity to be way more creative and really scale out. For this reason alone, we think that hiring a CFO in your business from the jump is a bad call. Now, like we run Landlord CFO. That's kind of our whole spiel here. But fundamentally, when we think about how you should begin to scale your business, you should start, like, as soon as you start making money, you should have a bookkeeper in play to make sure that the data is there. From there, you should hire a CPA or a tax professional that can take the bookkeeper's data and make sure that you're doing the best in your tax planning and maximizing the tax laws and all that stuff. We've got a whole other video on bookkeeping versus tax that we do. And then from there, once you've kind of got that position figured out, you can hire a CFO to help project your future. Where we see the CFO role kind of getting split, though, is in the fact that so many acquisition agents and underwriters and underwriting a property deals with that future, that bringing on a CFO it's a little aggressive if you're not of a certain scale. And like, really that role is kind of being serviced initially by your underwriting. Now, at some point, absolutely, having a CFO in play to help you project the future is worth its weight in gold, but we don't want you to put the cart before the horse here, because CFOs can be very expensive. So generally speaking, when we're first thinking about this, we're thinking about past and future, and really how this begins to scale out whenever we're thinking CFO versus accountant. The second way to think through having a CFO versus having an accountant is the difference between what is actual and what is possible. And this reflects itself in financial statements all the time. What we see in accounting, and what you should be seeing in your accounting numbers, is that whenever we talk about the properties that have been purchased by an investor, we never talk about ARV. Not once do I ever want to see ARV on a balance sheet on a client's set of bookkeeping. It should not be on your accounting at all. ARV belongs somewhere else. What I want to see is what you bought the house for and what you fixed it up for and what the rents were and what you spent money on. I want to see what actually happened. That's the accountant's realm, because if it actually happened, then you are actually legally able to do certain things with it. You cannot, like, if there's something that could maybe happen, that's really in the realm of a CFO. And so when we're working with a CFO, that's where we would want to see things like, what's the ARV? What's the expected ARV? What's the expected rent and expense growth for that area over the next 5 years? Like, what do you think about market trends? What do you think your cap rate's going to be by the time that you exit? If you ask a bookkeeper or an accountant those questions, they're going to drown. Like, they just don't think that way. They think of what's actual, what actually happened, what we can measure. That sort of speculation, that just isn't their purview. What they're really dealing with is what's actual. Whereas a CFO should be plugged into the market. They should be plugged into what's happening. They should have reasons and models and analysis to help you predict the future and really model it out and have the best plan moving forward. That's where we really like to see CFOs, is in that future casting. And that's also where you can begin to see a deviation between a CFO and like an acquisition agent. So if you've got somebody whose whole job is to go and buy your properties, they're going to do like their bigger pockets calculator. They're going to do the underwriting. They're going to say, oh, if like appreciation keeps going up by 3% a year, it should be worth this much when we're done. A CFO will be able to tell you what the weather will be like 5 years from now. Like, a CFO should be able to look at your whole portfolio and do a bunch of risk analyses and models, whereas an acquisition agent should really be hitting a very targeted list of criteria. If we hit these criteria, we know we'll be okay. A CFO should be able to help you really plan out the future of that, especially whenever things don't go 100% according to plan. And so truly, it's like, if we're talking about the past and the future, here we're really also talking about what actually happened, what measured, what we can go put our hands on and touch and see, versus what the future could be. And how neat would that be? And it hasn't happened yet. Like, we haven't sold that property yet. We don't have that gain yet, but maybe someday we will. And here's what we can do with it when that happens. The third thing that we really want to begin to leverage a CFO for, as opposed to an accountant, is leverage. And so I've mentioned this over and over again in this video, but accountants are really great at the law, and CFOs should be, especially in real estate, should be really good at leverage. And you'll see this if you begin to Google, like, what does a CFO do? You'll see this all over the place, where CFOs are really kind of depended on to potentially raise capital, build connections, bring in money, and then begin to help really like maximize the value of the dollar in the company. And all of these really fancy financial metrics that big companies really need. And that's all absolutely true. A CFO should be able to walk into a situation and say, you've got this many resources. Here's what we could do with it. And here's exactly how big and how awesome this could be if we would do these steps from a financial perspective. That is just awesome. That's what you want. Meanwhile, from the accounting perspective, what you want is compliance. What you want is the law to be followed. What you want is to not go to prison. And for that, accountants are going to come in to save the day. There are plenty of CFOs that like we've spoken with. There's plenty of ideas that we kick around that's like, well, if we weren't going to go to prison, we could do something like this and like that, but that's probably not the best law to follow. Like, let's go get a second opinion. Let's see what's going on. So there's a lot of dreaming on the CFO side that's followed up by some research, whereas there's just a lot of research and a lot of law and regulation and following the rules on the accounting side. Look, at the end of the day, when you're a business owner, you need both. You've got to have a way to make sure that all of your data is collected, that all of your ducks are in a row so you're not going to get in trouble, and how to catapult your business's growth. That's part of the journey here. And if your data is done right, you can find a CPA to make sure your taxes are done correctly, serve as that second opinion. And if you've got all of this handled, the next real big thing that you need is some sort of trusted advisor in your business, somebody that knows real estate, that knows the data, that knows the tax law, that's collaborating in your team, that can then help you leverage just by their sheer knowledge of finance. That person doesn't have to know how to swing a hammer if they know how to balance a checkbook, put together a cash forecast, begin to track KPIs and put together scorecards and issue valuations. Like, there's so many different miscellaneous skill sets that really help you leverage your finance by having a chief financial officer. This is part and parcel why we started with Lionshare Bookkeeping and why we started Landlord CFO. Just to kind of bring this all back together. This is part of our journey. Is we knew first things first, if we're going to do anything cool with our money, the bookkeeping has to be right. And if we don't want to spend all day chasing around tax law, we want to have a second opinion, then why not also help our clients dream and scale and leverage their business by offering landlord CFO services in our Velocity First accelerator? That's really where we like to see ourselves, is if we can handle the basics and help you scale up your business, then we can follow up with you later and make sure that that happens. And if you're not ready to outsource yet, we can take all of the lessons of Landlord CFO and Lionshare Bookkeeping and give them to you in our e-course program, which you can find the masterclass to in the comment section below, in the description below in the notes. So let me know down in that comment section what you found the most helpful, what you'd like to hear more about in making this CFO, accountant, bookkeeper, decision-making process. There's a lot of variables here. We've got our opinions. What have you tried? What's worked? What hasn't worked? What do you wish your CFO was doing that they weren't doing right now? Let us know in the comment section below. Thank you so much. Be sure to like, comment, and subscribe, and we will see you in the next video.